This one simple trading strategy has made me over $70,000 from one prop firm last month. Now, before you think this is some complicated system that requires years of experience, let me be clear. This is the easiest, highest probability setup that I know. And it's repeatable enough that I use it on every single funded account that I currently manage. And real quick, before we actually dive in, this is for educational purposes only. This is not financial advice. I'm not a licensed financial advisor. Trading involves risk and results will vary. But the strategy has proven to work for me and my students when we execute it with proper discipline. And in this video, I'm breaking down the complete strategy for free, showing you real examples of how it's made me money and walking you through exactly how to spot it and execute it for yourself. Let's get right into it. The reason why this strategy works is because it doesn't just focus on one market condition. It actually works in all sorts of market conditions, an uptrending market, downtrending market, and a consolidating market. The reason why this strategy works so well with prop firm accounts is because it has very clean risk management and a clear set of rules on where you have to put your stop loss. And if your stop loss gets hit, you are out of that trade and you have to wait. You have to be very patient. And it also has very clear profit targets, usually over a 2R most of the time. What you're basically doing with this strategy is you are trading candles as ranges. So this gives you an edge because in theory, when you are trading a range, if the range high, for example, gets taken, then you are aiming for the range low to get taken next. And that's why this strategy gives you a very clear edge, especially when trading prop firms. All right, so jumping onto the charts here. So we're not really looking for a specific market structure, right? This works in all markets. This works in a uptrending market, downtrending market, and a consolidation market. Okay, so if you are trading a uptrending market or a downtrending market, the easiest way to identify a setup in a uptrending or downtrending market is, again, we're gonna be trading candles as ranges, okay? So if we are trading an uptrending market, what we are looking for is pretty much this pattern here. We are looking for the second candle to sweep out the previous candle's low, and then expecting that third candle to be distribution to the upside, right? So let's say, for example, when we're trading an uptrending market and we have those fair value gaps that I taught you guys, right? Especially ones that break highs. A lot of time you'll see it like on the 5-minute, 15-minute, you'll see a 3-candle pattern just like this, right? So you'll have 2 candles. One of the candles, the manipulation candle, the second one that sweeps out the previous candle's low, will tap into a fair value gap, for example. And then what you're doing and what you're expecting is this third candle to be distribution to the upside to continue that uptrend, right? It's the same thing for a downtrend, but the opposite, okay? So if you're in a downtrending market, you are basically looking for retap of, it could be a fair value gap, it can be, you know, one of the lows that got broken that are getting retested. What you're looking for though is just that same pattern, right? It's just 3 candles, that second candle to sweep out the previous candle's high, and then that third candle to be distribution to the downside, okay? Because the second candle is considered manipulation, but if you're trading continuations in a downtrend or uptrend, you're basically looking for this pattern. More on this here in a second, but that's basically what you're looking for. Now, in a consolidation market, you're basically just looking for the same thing, right? You're looking for pretty much this here, and then you're expecting distribution on that third candle, okay? So the secret is not to enter on the second candle, but to enter on the third candle. Now, you guys just seen what the pattern looks like, what the strategy kind of looks like. Again, more on this here in a second, but where your stop loss would go would be at that second candle's high or low, depending if you're bullish or bearish or trading in a consolidating market. Your stop loss always goes above that second candle's high or low. If you're bullish, it would go below the candle's low. If you're bearish, obviously it would go above the candle's high. The typical risk to reward ratio with this sort of strategy is always above a 1.5R. I haven't really seen this strategy offer like a 1-to-1. It's always a 1.5 or 2R max. And this works out over time because with this strategy, I always get about a 60 to 70% win rate. So over time, the math makes sense. Let me show you actual trades using this exact setup that contributed to the payouts I mentioned at the beginning of this video. Now, I want you guys to keep this in mind. Not every single trade with this strategy or any setup, strategy, entry model, whatever you want to call it, every single trade is not going to be a winner. Get that through your thick skull and really realize that. But with the 60 to 70% win rate combined with the 1.5 to 2R risk to reward ratio, this makes it profitable. Let's go ahead and jump onto the chart so I can show you guys what setups I took that contributed to these payouts. All right, so jumping back into the charts here. So just like I told you guys in a downtrending market, because obviously we were downtrending here. In a downtrending market, if I'm looking for continuations, I'm looking at the higher time frames really quick. So on a daily chart, this was downtrending, right? You could obviously see this from a 1-hour chart perspective. objective. So if you bring your attention over here to these daily candles that I have on the right, you see how this new daily candle here swept out the previous daily candle's high and it tapped into a daily fair value gap. I'm looking for continuation lower, right? I'm looking for this low down here, possibly, you know, any other smaller lows on the lower time frames. But the main objective is the previous day low, this green candle here. Since we took the high out, I'm looking for the low now. So again, this is why it makes the strategy really work well, because if you're trading candles as ranges, the logic is if it takes the range high, then the next objective should be the range low, right? Given, you know, a few different things like I'm about to show you here. So since we're looking at the daily, I'm looking at the 1 hour specifically because that is the lower time frame that is aligned to the daily chart. Okay, so what do we have here? We have a break of structure, right, on the 1 hour chart. This low here made the most recent high that broke those lows. Okay, so this is a break of structure right here. Okay, and what do we have next to this break of structure? We have another bearish fair value gap, right there. So when the market is about to open, I wanted to set limits right here, and that's exactly what I did. So if I just bring it back here, I had set a limit of about 3 contracts in this fair value gap here. So if we fast forward it, market opens, it has a Judas swing up here. Now this entry was really good and my stop loss was actually right here. I didn't want to see this invalidate this fair value gap here, because if you think about it, we're coming to retest this low that broke, right? And we're coming to retest this bearish fair value gap that broke this low. We're coming to retest a couple other things like this breaker block, the CISD, and I do not want to see this fair value gap get invalidated. So my stop loss goes right there. And now since I got a really good entry here, my take profit could be all the way down here at a fresh low. Okay, so if we start going to the lower time frames, like the 15-minute, for example, you can see there's a 15-minute high and a 15-minute fair value gap there as well. So this gives me extra confidence that the trade is actually going to work out. And if we fast forward this trade here, you can see that we actually ended up hitting the take profit for a total of $17,000. So that was a very, very big trade for me on my alpha accounts that contributed to the $70,000 in payouts from one firm. Now let me show you guys another trade example here that I took on these accounts. So you can see we have a 15-minute range and the trend was down all day. It was literally just kept going down, right? So on the higher time frame, if I were to go to like the 4 hour really quick, you can see what the market was trying to do. It was trying to draw down into the previous month lows, right? The October lows, the sell side liquidity right here. So we had massive displacement lower. Obviously the trend for the day was bearish, okay? So I'm looking for setups, I'm looking for ranges that fit that context and narrative, and that gives me the entry model, okay? A lot of people know entry models, but they forget the basics, the market structure. What is the market doing for that day? It's obviously downtrending, and I have a setup right here that fits the context, and our objective has not been taken yet. And we're obviously displacing towards this line down here, the line I just showed you, right? The previous month lows. Now, you can see here, we push up and we actually have something called an SMT divergence, where one correlated asset, for example, this is the NASDAQ. So the correlated asset to the NASDAQ is the S&P 500. So this basically means a bearish SMT divergence is basically when one asset makes a higher high at a point and the other correlated asset does not. So for example, right here in this example, ES actually made a higher high and NQ did not. So knowing that and us closing inside the previous 15-minute candles range, right, and sweeping the high of it, and then also getting a change in the state of delivery right here, which is basically the same thing as a market structure shift or a break of structure, and then forming a 1 minute fair value gap right here. This is where I executed my entry. I believe I broke this trade down as well in my previous video, but I ended up executing right here and targeting this higher time frame low with my stop above this 1 minute fair value gap right here for about a 5R trade. Now this did take all day to deliver, and I could have took profit here, and I did trim one there, I believe, but the main take profit was at that higher time frame low, because again, that was the higher time frame objective. And that's why this trade setup here specifically was very, very good, because it fit the higher time frame context and narrative. All I had to do was just find a lower time frame entry, which was the 15-minute to 1 minute. And again, if I just let this play out, you'll see it eventually got hit during the last 20-ish minutes of the market. Okay, so showing you guys one more trade example here. This is actually a break-even trade. It wasn't a loss, it was a break-even trade, but I'll explain what I was looking for here. So basically the market was pushing up and we were drawing up to this buy side here, But if you see, there was no 1 hour range or anything like that. If I go to the 15-minute though, there was a 15-minute range we could have used right here. And now I did use it, but I was late to the entry. So you can see that the market came back, it pulled back to this 15-minute fair value gap here, this bullish one. And I was thinking that this bullish fair value gap was going to deliver us up to this buy side level right here, this liquidity level. Now, again, we closed inside the previous 15-minute range right here, right? We swept out the low, we closed within it. Now, if I go to the 1 minute, all I got to do is just find that break of structure, right? That market structure shift, the change in delivery. Now, you actually ended up getting it right here, okay? So this little short-term swing high made the lowest low, but then we broke through it, okay? But we never came back and retested it, all right? You can market enter when it closes above it if you want. All right, I usually like market entering, but in this case, it was just very, very choppy all morning, right? Very consolidating. So the choice or the better choice was to market enter here instead of waiting for a pullback. But I wanted to wait for a pullback to get the best possible risk to reward. Fortunately, I did not do that. So when we fast forward this trade, I was waiting for break of these highs and pretty much a fair value gap to form above these highs, which was right around here, right? We also had a 5-minute fair value gap right there and a 1-minute fair value gap right here. So I wanted to execute right here and we ended up executing there. And this trade just ended up going sideways for a little bit and I ended up getting stopped out at break even. There was just too much consolidation and I just ended up getting out at break even, and you can see what the market ended up doing, okay? So I was looking for higher. Unfortunately, the market didn't give us higher. We just ended up coming back and ranging for the rest of this day here. Believe it or not, this strategy appears numerous times on multiple time frames per week and even per day. It stacks up week over week and month over month. Again, with the 60 to 70% win rate using this exact setup over and over again, it really stacks up to create consistent profitability over time. By the way, if you want to master this exact strategy to help you get funded, click that first link in the description to learn more. If you guys are just learning how to trade candles as ranges, especially if you have no ICT knowledge prior to this video, or maybe you do, give it about a month or two and I'm pretty sure you guys are going to be able to grasp this setup. I also have a lot more videos on my channel explaining this exact model, and I also have a couple backtesting videos that also showcases this exact model if you guys would like to go watch that. The biggest mistakes when trying to copy this exact strategy is trying to pattern trade it and not having any narrative or context from what the higher time frames are doing or what a specific day is doing. For example, if we're downtrending all day, then you are looking for setups to fit that narrative for that day or the overall higher time frame picture. If it is drawing to a higher time frame low, for example, the chart example I showed you, we're drawing down to the previous month low. What I'm looking for is lower time frame entries that fit that context and narrative. A lot of traders just try to pattern trade this. They try to just take whatever entries, multiple entries a day, trying to pattern trade this on the 5-minute, the 1 minute. Is just not going to work out if you're going down to those lower time frames as well. That is another mistake that a lot of traders make, is trying to trade this exact strategy on very low time frames like the 5-minute and 1 minute. I would recommend sticking to the 15-minute for this strategy as your lowest higher time frame, because the aligned lower time frame for the 15-minute is the 1 minute time frame. I know that might be confusing, but you guys can rewind it, watch that back. It's very important that you stay patient with this setup and only take A+ setups that fit the context and narrative from the higher time frame or whatever that specific day is doing. It's very important also to be trusting one model instead of mixing a whole bunch of different strategies all together. A lot of people confuse strategy and entry model. Again, when you have the higher time frame context and narrative from what a specific day is doing or what the overall higher time frame is doing, it's very important that you master one high probability setup and approach instead of mixing in 10 mediocre ones or mixing in a bunch of different strategies that you guys probably watched on YouTube. Mastering one strategy, one entry model, and mastering the context and higher time frame narrative is going to be very important, because if you don't and you start mixing in a bunch of different things all at once, you're going to be very confused, you're going to hesitate, you're going to have FOMO when you miss your entries. So be very, very careful and just master one entry model and approach. So that's a complete breakdown of the simple funded trading strategy that made me over $70,000 with one prop firm last month. It's not complicated. It doesn't require a million different indicators or knowing a million different things, and you don't need to trade all day. That is the most important part. You just need to know what you're looking for. Wait for it to show up and execute it with discipline every single time. Now, if you're serious about getting funded and want to learn this strategy in depth with extra help personally from me, click the first link in the description to learn more. Subscribe for more, and I'll see you in the future, guys. Peace out.